market around the world has been reaching the all-time high. This is a S&P 500 chart. You can see clearly year to date, S&P 500 has gone up almost 16.38%. It's only like 6 months into 2023. You have another 6 months to go. Who knows where the market will go, but like for 6 months, 16%, it's a phenomenal return, guys. But will it continue like this? I think for short term, it may have some issues. You could also see that inflation was high last year. Because of that, market it came down quite a bit. It was a good buying opportunity for a lot of people. If you had invested around that time, kudos to you. You could have reaped the benefit, because as you can see, the market has gone up high already. But since the inflation went up, the central banks around the world started tightening the monetary policy. US Fed increased the interest rate beyond 5% now. Thanks to that, like the inflation rate has come down all the way to 4% as of June 2023. But still, it's far from their 2% target. Recently, Fed Chairman Jerome Powell came back and he said they think the fight against the inflation is still a long way to go, and he believes that there can be 2 more interest rate hikes going forward. So, which may not be a good news to the stock market, but they have to do what they have to do. And this is the US Treasury yield curve, which you can see currently it is inverted, because the short-term rates are high compared to the long-term rates. So, which is a classic indicator there is a recession around the corner. But US economic growth expanded much faster in the first quarter than previously estimated. Due to this, analysts have lowered US recession probability. So therefore, these situations have made investors to think if it is a good time to invest in current market, because the valuation has already gone up high, So in this video, I'm going to explain the valuation, what I think about the current market valuation, not only US, Canada and India, and where you could possibly invest your money, and where am I investing. This is the S&P 500 CAPE ratio. The P ratio is a classic measure of stock value, indicating how many years of profit it takes to recoup an investment in the stock. The current CAPE Shiller CAPE ratio is 30.8, which is more than the historic average. This is like 52.2% above the modern era market average of 20.2. 20.2 is the classic average, but now it's around like 30.8, putting the current PE ratio almost 1.3 standard deviation above the average. So which means the market is highly overvalued. The next thing is the buffer indicator. So buffer indicator is the ratio of total stock market divided by the particular country GDP. So this is like for the US. In US, as of June 30, 2023, the ratio is calculated. The ratio fluctuates over time because the stock market fluctuates, but the GDP tends to grow much more predictability, right? So the current ratio is almost like 177% ratio of the market value to the GDP, which is approximately 47.99% above the historical trend. This is the historical. So this is almost like 47.99%, and it's almost like 1.6 standard deviation above the trend line. So which indicates that the the stock market, the US stock market is overvalued relative to GDP. Most of you already know this, but just want to bring it to your attention. S&P 500 consists of almost 11 sectors: communication services, consumer discretionary, consumer staples, energy, financial, healthcare, industrial, information technology, material and real estate, and utilities. And as you can see, information technology is almost like 26.1% of S&P 500, so which is the heavy weighting, and Apple, Microsoft, Nvidia, Google, Meta, and Tesla are the top companies with largest weighting. So this makes the index to be skewed, and at times the valuation of S&P 500 is driven by price of these stocks. And as you know, in last few months, like since the beginning of this year, Apple, Microsoft, Nvidia, Tesla, Meta, Alphabet, they are all making all-time highs. So which is why, in my belief, basically the information and technology sector is actually driving the S&P 500 pretty much. The valuation that's why is high. But if you look under the hood, there are certain sectors which are actually lagging behind when you compare to these information technology. So that's where I see you can find more values. Apple recently hit $3 trillion market cap. So just to put that in perspective, Apple's market cap is larger than Italy, Brazil, Canada, India, Russia, all these economies. Same thing like Microsoft market capitalization is around like 2.5. So which is larger than most of the developed economies. On the same note, Amazon also hit the all-time high. I think they are around 2.3 trillion market cap. When they compare to other market GDPs, they are kind of doing well and position. So for example, if for example, as of June 2023, the forward PE ratio of various S&P 500 sectors are, so for example, communication services has 21.7 forward PE ratio, consumer discretionary is 26.1, consumer staples is 19.7, energy is 10.4, financial is 13.1, healthcare is 17.9, and utilities is 18.9. So based on all these forward PE ratio, the one that I've highlighted in red, I find those have lot more value. So as an example, you look at the financial sector, you saw the financial sector has only PE ratio of 13.1 when compared to the larger market, which is almost like 23 or 24 forward PE. So you could see there is a value under the hood. Now in financial, due to this bank run and whatnot, the market is discounted. Financial sectors, you cannot go and invest money everywhere, right? You need to find good companies. So in my view, these are the top companies that I feel, if you want to put your fresh money towards, you can invest. But I would want to give you caution. So for example, you could put your money around S&P Global. This is a good company. This stock price went up little high in last few months. So I would wait for an entry point before getting into this stock, but it is a good stock, right? Same thing, Moody Corps, they are also credit rating. They have similar, they are similar to S&P Global Link. But again, the PE ratio is 46.53. So I wouldn't be investing at this point of time. I would wait for pullback, and I will invest the money slowly, right? Morgan Stanley, there are few stocks that has really a good PE ratio and compelling valuation at this point of time. Perhaps maybe I would invest there. For example, Morgan Stanley, which has a PE ratio of 14.67. The last quarterly earning, they every segment was doing good except for investment banking, because as you know, there was not a lot of mergers and acquisitions that are happening. But otherwise, the solid company, I would use any down time in the in this company. Like, I mean, in a coming months, if there are any downtime, I would pick some of these stocks. I would invest them slowly. Let's say if you're not comfortable with Morgan Stanley or whatever, you could invest in Visa or MasterCard. Year to date, they have been like almost 14-16%. So as I said, like, they are similar to S&P 500, like they have gone up quite a bit. So I would wait for some opportunity to enter. But these are some of the good areas one could put their money towards, given that valuation are rich everywhere else. But now coming back to North American market, for example, I'm from Canada. S&P TSX did not perform that well when compared to S&P 500 or Indian stock market. It is only year to date, it is only up like almost 3.66%. But if you think about the CAPE ratio, this is like a Barclays CAPE ratio index. You could see when compared to USA is like the bluish one. It is around like 30, which we already saw in the previous segment. The CAPE ratio is 30.8, which is almost indicating the US market is overvalued. But if you look at the Canada, it is only around like 20. The CAPE ratio is only 20. So I believe from the value point of view, TSX composite index provides good value. But now I wouldn't go and invest everywhere, right? For example, if you look at the S&P TSX, the largest weighting is the financial, and followed by energy, industrial, materials, so on and so forth. The rest is all like very, very, very insignificant per se. I wouldn't invest everywhere. For example, I picked I put this chart which shows information technology. Here it's comprised of almost 7.9% of the index. So till year to date, the information technology sector has performed quite a bit, very good. From the valuation perspective, I believe this information technology sector is little overvalued right now. I would wait for some correction and then put fresh money there. Otherwise, Canadian index, the overall index has a good value. You can index, right? You can put your money there, or you can put some money in the energy sector. I invested only in the information technology index and the banking sector, which pretty much covers. And I also have energy ETF. Canada provides good value at this point of time when compared to US market. The valuations are cheaper, so you could invest your money there. Now, the next thing I want to talk about is Indian market. Indian market year to date has gone up almost 6.18%. Recently, it broke 19,000 mark, which is a big number. It was kind of range bound for last few months. I believe Indian market will do good going forward. There is an election year coming forward, so market will grind slowly, but depending upon how the election goes, the market may go up high, because the Indian GDP is really doing good. Like if you compare, they are like anywhere between 6 to 8%. Good opportunity. But now, given that the market has gone up almost 6.18%, I don't think everywhere you can invest, because you see this is the CAPE ratio by Barclays. When you compare, like US is around US CAPE ratio is around 30.8. India's CAPE ratio is around the same. So as far as the valuation of the Indian market is concerned, it is quite high, but you can find some value in the financial energy sector. But energy sector, I don't know how good they are. So perhaps you could invest some money in financial services because the PE ratios seems to be okay, and also the PSU banks. PSU banks are like public, uh, the government-owned banks such as SBI, Punjab National. These are good, largest bank, but since they are being like nationally owned, you wouldn't find that type of a management compared to these private banks. So where do you invest? So these are some picks for India. So for example, I would invest some money in HDFC. Not right now. Right now the market is it is overvalued in my opinion, but I would find an opportunity to enter into HDFC Bank, which is one of the India's largest private sector bank. You could find a value there, or you can invest in the information technology sector. Right now the information technology sector is not doing that great because of the US recession fears, so which I think would be a good opportunity because these are solid companies, they would do good, so these would be a good opportunity to buy it. Dr. Reddy is like another multinational pharmaceutical company, so they have a lot of patents and whatnot, so it's a solid company, solid balance sheet, so I would buy that. So the reason I pick these stocks because they are available in New York Stock Exchange, so one could buy them as an ADR. But let's say like if you don't want to pick specific stocks from Indian market, I am also recommending Nifty 50 index for a long-term run. In short term, the valuation is high, so I believe there will be a market correction. At that point, you could invest here in these recommendation that I provided if you find it comfortable. If what I'm saying doesn't make sense, you can comment on the comment section and for what you think.